You're welcome to the 6th edition of the Market Data Workshop. My name is Anita Gopaldas, and with me here is
Rosemary Wogo
and
Dr. Maria Kinyemi.
So we will be talking about the workshop and how you can gain the most out of this program today. The Market Data Workshop is running in its 6th edition, and it was created by the Market Services Department to increase the awareness of the importance of market data and also to establish the Nigerian Exchange Limited as a leader in promoting research, technical analysis, and fundamental analysis on the capital market. So the theme of the workshop, this year's workshop, is how to power investment strategies using market data through derivatives. Now, before we delve right into derivatives, we would like to discuss or highlight market data products. Market data products that we have at the exchange are real-time data, historical data, and also end-of-day information. Our end-of-day information, for instance, we have our reports that is being used by brokers. We also have our broker performance. But before I get Rosemary to highlight that, we'll also like to talk about the X Mobile. The X Mobile is a mobile application that contains market information and gives you updated pricing information on all your favorite stocks. So you can please go to the App Store to download the X Mobile, and then you would love the experience. We also have the X Data Portal that is a repository of all our market information. It's used by trading license holders, professionals, and also students for research and for any other technical analysis. So we go right into the broker performance report. Rosemary here will give us more details on that.
Thank you, Anita. The broker performance report has been revised to show the performance of brokers ranked by the sum of the total calculated points in volume, value of trades, and number of transactions across all asset classes. One of the benefits of this report is that it ensures a level playing field across all market participants. It also drives competition and also encourages more market activities in other asset classes like derivatives, ETFs, and fixed income. There are various ways to access this report as well as other ad hoc market data reports. You can access it via the X Data Portal, or you can reach out to Contact Center or Market Services.
Thank you very much, Rosemary. So we will delve right into derivatives. If you're retail investors or you're just enthusiastic about the market, you may wonder what exactly is derivatives. So Dr. Akemi, what is derivatives and why should we be concerned about this new product?
Thank you so much, Anita. Yes, derivatives are very popular and very important in today's market. What is a derivative? A derivative, as the name implies, is based on an underlying asset. This asset could be a stock or a commodity or just any random product that you can buy or sell. All right, derivatives can be used by speculators, arbitrageurs, or people who are just interested in hedging, meaning protecting themselves against slides in the market. So an arbitrager is just somebody who gets something out of nothing. You can put in nothing and still get a lot more. It's completely risk-free, well, mostly risk-free if you ask me. So speculation is simply basing your trading strategy on a hunch. Maybe your price is going to go up or come down, and you decide to take a position based on that. Hedging is the most important bit of, well, I would say it's the most popular part of derivative, or the further usage of derivative, because it can be used to protect yourself against risk. All right. So what you do in hedging is to take an offsetting or opposite position in an asset or in a derivative that is corresponding to an existing position. All right. The aim really is to maximize profit and minimize risk exposure. All right. So to get a fair price for a derivative, you need to know the historical behavior as well as the real-time behavior of the underlying asset as well as the derivative. And market data and historical data is the only way to do this.
Thank you very much. That is quite interesting. Rosemary, how do we get the most out of this event?
So to get the most out of this event, aside from joining the live session, you can visit the sponsors exhibition booths to explore the various products and services that our sponsors have available. You can also visit the networking lounge to chat with participants, speakers, sponsors, and also members of the exchange. You can reach out to the tech support team to assist with any technical related problems you may encounter during the program.
Thank you very much, Rosemary. And don't forget, the main program starts exactly at 10:30. So while you're at the networking lounge or the exhibition hall, do not forget to click on the auditorium or visit the landing page of this platform to join the live section. Thank you. I hope you have a wonderful event this year.
As you adjust to the new realities for operating your business and engaging with your customers, let us help you transform your business into a digital powerhouse capable of adapting and taking advantage of today's opportunities. With our best-in-class array of digital solutions, you can conduct your business, receive payments from your customers, and perform transactions quickly, safely, and conveniently, because we've got you covered with the right people, technology, and service offerings. Contact us today and let us take your business to its zenith. Zenith Bank, in your best interest.
Good morning, everyone. Thank you for joining us for the 6th edition of the Market Data Workshop, the Nigeria Exchange. I am Wole Famiriwa, and I'm delighted to be your moderator for today. I like to say that knowledge is key, but in this era of the expanding digital economy, I'll say data is golden. So we're delighted to have a very distinguished lineup of speakers who will be doing justice to the theme of this year's event, which is how market data powers investments using derivative products. So you're all welcome, and I hope that you've enjoyed the interaction so far on the FAIR platform, and we certainly look forward to having you back on that platform at the end of this conference segment, if you like, of today's event. Before we go forward, just a few housekeeping issues for you to note. First, this event is being recorded, so please be mindful of that. And we're also live streaming on YouTube and other platforms. Beyond that, we'll be opening this up for questions later on. So if you would like to ask questions, especially during the panel session, please fill out your questions in the Q&A field, which you can find on the platform. And if you would like to engage the team at the NGX at any point, also feel free to drop a message in the chat field. So on that note, let's get started. Without further ado, I'd like to now welcome the CEO of the Nigeria Exchange Limited, Mr. Temi Popola, as he delivers his welcome address.
Thank you very much, Wole, and good morning to everyone who has joined us this morning. We're delighted to have you. On behalf of the board, the management, and the staff of NGX, Nigerian Exchange Limited, I welcome you all to our 6th Market Data Workshop. The theme of the workshop this year is on how market data powers investment strategies using derivatives products. We're truly pleased to host this event and believe that the forum will be of immense value to all of you. In demonstrating our commitment to create stronger markets across Africa, NGX organizes events such as this to create awareness on the importance of market data as a fundamental input in facilitating research, fostering new strategies for improving market transparency, and making wise investment decisions. This workshop brings together industry experts in the field of market data. It brings together researchers, buy-side and sell-side firms, academics, and policymakers to share original research and exchange ideas in an enriching conversation to improve the understanding of market data and its application among participants. The global derivatives markets have grown dramatically over the last 2 decades, despite the global financial crisis in 2008. The rapid development of digital technology in finance, along with innovative financial engineering and regulatory influence, play an important role in the expansion of the derivatives markets. Based on data from the World Federation of Exchanges, The global derivatives market saw a 40% increase in trading volumes in the year 2020 alone. And this increase was more than 3 times larger than it was in 2019, where the market witnessed an 11% growth. This increase is by far the largest seen in the last 15 years, including the great financial crisis of 2007 to 2008. This significant growth was attributed to the increasing need for risk management under the heightened levels of uncertainty and volatility produced by the COVID-19 pandemic. Trading activity by asset classes in 2020 saw the highest number of equity derivatives contracts traded in a year, about $26 billion in the 10-year period under review. Stock index options were the most actively traded derivatives product in 2020, accounting for 20% of overall derivatives volumes. Through cutting-edge technology, Nigerian Exchange Limited continues to promote a high level of market transparency by enabling easy access to quality, real-time market data to all market participants, including regulators. Market data such as transaction prices, bid offer prices, and other trading information becomes the bedrock for price discovery and investment strategies. Derivatives traded on exchanges disseminate price information that aid both private and public entities because exchanges make contract volumes and prices publicly available. Such transparency helps markets function more efficiently. Recent research has also documented that constructive development of derivatives markets in emerging market economies need to be supported by sound macroeconomic fundamentals, as well as updated financial policies and regulation. To deliver maximum benefits to its users and to the economy, the derivatives market must meet 3 prerequisites. Derivatives trading and clearing must be safe, the market must be innovative, and it must be efficient. Market participants, policymakers, and regulators should support the providers in the derivatives market to ensure these prerequisites are in place. Since demutualization earlier this year, NGX continues to prioritize the evolving needs of existing and potential investors by building digital ecosystems that deliver value in the customer's journey and protect business integrity through various products like the X Data Portal, the X Whistle, the X Bot, and most recently, the X Factbook and the X Mobile. As a multi-asset securities exchange hub, NGX has pioneered a collaborative approach to advancing financial literacy and inclusion through a range of initiatives by engaging in the next generation of investors and providing training through its dedicated learning arm, the NGX Academy. We recognize that making well-informed financial decisions play an important role in the ability of individuals to manage their financial affairs and to contribute effectively to economic activities. I'd like to conclude by thanking our official partner, Zenith Bank, our premium partners, Reliance Info Systems, Infoware Limited, MTN, CSCS, United Capital Securities Limited, ARM Securities, New Logic Solutions, NG Clearing, Codros Capital, and APEL Asset Limited for your kind contributions to this event. I welcome you all once again, and I hope that you derive as many benefits as is available through this workshop. Thank you all very much for listening. Wale, over to you. Thank you.
Thank you very much, Mr. Temi Pokola, for that welcome address. I think it sets the tone nicely. And many thanks again to all our partners and sponsors. Moving on, as we set the tone further for the event, I'd like to now welcome he is the head of department market services at the Nigerian Exchange. Please welcome Mr. Femi Balogun as he delivers a theme presentation.
Good morning, everyone. As introduced, my name is Olufemi Balogun. I'm the head market services at Nigerian Exchange Limited, and I'm going to present the team. how market data powers investment strategy using derivative product. So I'm going to start by, I think, sorry, I need to. Oh, we had a technical issue this morning with the presentation. So I'm actually, yeah. Wally, can you pause it a little bit? Let me just rectify this so that everybody can see the presentation, please. All right, let's just pause.
Okay, sure. I think, thank you, no problem. Hopefully we'll allow you to get the ducks in a row and we'll have that presentation in a moment. In the meantime though, I'd like to draw the attention of all our viewers to one of several partners that we have. We have a short message from one of our partners. So we can play that now while we sort that issue with Femi's presentation. Many thanks again to all our partners. Just to check with you now, Femi, are you ready for us or do you still need some time? Hello, Femi, are you ready to go or should we perhaps come back to you in a moment? Maybe we can move on to the next.
Yeah, sorry, just come back to me in a moment, please.
Okay, all right, that's fine. Okay, in the meantime, we'd like to move on to take a presentation. I wonder if Uwa Agbonile is standing by to deliver his presentation on bringing the next 2 million investors using derivatives to drive liquidity. And before he begins to speak, Uwa, are you there? Just
yes, I am.
Okay, wonderful. If I can just take a moment, just so that our audience know who you are, just a brief introduction about Uwa. I mean, Uwa has incredible experience in the tech space, if I can use that phrase. He is the CEO of Infoware, and he's also one of the managing partners of Solatoris LLC. He has well over 20 years experience in the technology industry, having worked at places like Citibank, Chevron, and where he was a manager of a development group in SQL Server, spanning Redmond in the United States of America and Vancouver, Canada, as well as Shanghai, China. So he really has a plethora of experience and we look forward to listening to his presentation. So the next voice you'll be hearing will be Uwa's. Uwa is over to you.
Thank you very much. So,
I know you have a presentation, please go ahead.
Yeah, let me share my screen and then the presentation. Okay, so first of all, thanks everybody for joining us this morning. Great to be here. And I want to thank the Exchange for organizing the event and for inviting us. We think this is very, very good time to be doing this. So I'm going to run through this presentation.
Okay, I'll fix it. Yeah, I'll fix it.
Okay.
Okay. Who has actually started? Maybe we can take yours right after. Is that okay? All right, please go ahead, Uwa.
Okay, so we'll run through this. So the theme of my presentation is bringing the next 2 million investors into the capital market and then using derivatives as a means of driving liquidity to enhance the market and overall to, make both retail and institutional investors more comfortable and make the market much more versatile. So the first thing, I want to talk a little bit about derivatives itself. What exactly is a derivative? And I think that word, it strikes this tone sometimes of becoming very, very complicated. You know, there's a lot of math behind it and all that stuff. But however, let's break this down a little bit. Derivatives have actually been with us since the start of time, or at least for a very long time. Our ancestors, I'm pretty sure our great grandfathers, they were mostly farmers, right? They were using derivatives, and a lot of our market women today on a day-to-day basis actually use it. They just don't call it that. So what's the derivative? So let me use the example of a yam farmer and somebody that sells yam in the market or that uses yam to make pounded yam and stuff like that. So if you're a restaurant, right, and you know that you make pounded yam and you have a certain number of customers and you know the size of your customers, you want a reliable supply of yam, right? Now, the farmer, if the farmer doesn't farm enough of those yams, then by the time it's time for you to, produce pounded yam for your customers, you are not going to have enough. So what a smart shop owner or market person will do is to go and have some sort of an arrangement with the farmer to guarantee their own supply. And that kind of arrangement could be something like, okay, you know what, Mr. Farmer, I'm going to need this number of tons or this number of tubers of yam for my production, whatever it is that I'm needing. Then Mr. Farmer says, okay, if that's what you're going to need, then okay, I'm going to farm this size of hectares of stuff. Then there's an arrangement that's made that Mr. Farmer says, but you are going to commit to buying this thing from me because otherwise I'm going to have a ton of yam that I can't sell. And the other guy says, you're going to commit to producing this stuff for me so that I can have it at the time. And they agree potentially on actually some level of pricing at that point. What you just have there is a derivative. That's a futures contract. So now in the modern day, it can get more complicated in terms of how you transfer it from hand to hand and stuff like that. But that's essentially a derivative. And so there's always an underlying asset. In the capital market, for example, the underlying asset could be the equities, a fixed income, or any other kind of thing that's underlying it. So I just want to use this to demystify derivatives and make it so that it doesn't sound as complicated as we all make it out to be. Okay, so now, how does that impact on what InfoWare is doing? So the key here is bringing in liquidity into the ecosystem. And of course, bringing in the investors, right? Creating more financial inclusion. We have a theme about building wealth, right? So how are we going to do that? So first of all, before we do that, I want to talk about a little bit about, there are certain myths that exist in our ecosystem today that we want to kind of demystify a little bit. One of them is that Nigerian investors are risk adverse. Another one is that there are not enough disposable income within our ecosystem. And then of course, there's another one that other investment options are better than the capital market. So what exactly are the facts when you look at the facts now, not just looking at myths per se? So first, the Nigerian market is the second largest market for crypto worldwide. Crypto, I'm sure everybody would agree, is one of the riskiest assets today. It gyrates up and down, goes up, and yet Nigerians trade crypto. We're the second largest market in the world. It's totally mind-boggling, considering the risk that's in there. Number two, fintechs have shown that there's a lot of appetite in Nigeria by investors to invest. They probably just don't have the means or the right mechanism for doing it. So for example, a number of fintechs recently, they've acquired close to 1 million new customers over a period of about a year or thereabouts, just even around this COVID ecosystem. And if you compare that to the size of the market in terms of the tradable spectrum of people within the capital market, it's just mind-boggling. It's night and day. So there are enough interest. They probably just don't know how or where to go to engage. The last one is that other investment options are better than what the Nigerian capital market presents. Again, that myth is blown away. There was a study recently by FDC Nigeria and another one report by Bloomberg. The Nigerian capital market was the best performing market last year. Just yesterday, I was looking at the performance this year, and I know that the oil and gas sector index within the Nigerian capital market, if I remember correctly, performed close to up to 70% year to date this year alone. So there's performance. So the key issues there, therefore, seems to be other things. And that's what has inspired this product that we're bringing to the market, the Idiot Trader. Now, InfoWare does a bunch of things. We produce the ERP on the back end. So what we've decided to do is go upstream and try and solve a lot of the problems that exist so that the entire ecosystem can become more flexible, including, and the ecosystem is open to other fintechs to participate. We are more interested in providing the base platform that includes market data, the trading platform, and so that we can enrich the overall ecosystem. So the design, simplicity, powered by real-time market data, which is the theme of this event, absolute flexibility, then an AI-powered advisor. So the AI power in here means that for the system to show you what your portfolio looks like, what risks are inherent in your portfolio, the kind of things you should do, it guides. It doesn't just provide you a platform that says go and trade and you're left on your own. It continuously informs you. So a few things about the Idea Trader screenshot itself. So we just run through. So there are some of these things. You come in, there's a pro mode and a wizard mode. The wizard mode is meant for the Gen Zs or the person that just wants to be guided through. It shows your portfolio and it does some sort of analysis for you. Now, some of the key thing, one of the key fundamental thing that this thing does, it has theming, but this particular shot here, what this is doing is that instead of showing you the basket of over 300 equities and fixed income that you can trade, it curates them using our artificial intelligence analysis mode to say, okay, here are some of the things that probably will interest you. For example, say a long list of them. It could be derivatives, the best performance. These are in real time, the best performing stocks. Which ones are the high dividend one, the ones with unusual volume as is happening at that point in time. So that you, the individual, the retail investor, can have the same level of power as a high-end broker, irrespective of where they might be in real time. The theming thing, you can make it suit whatever screen or colors that you like. It's all customizable for you. Then this is the pro mode. The pro mode is using WebSocket technology, all based with mobile or web, in which you can see actual activity that's going on in the market in real time. This is not the 15-minute delayed or anything like that. It's fully 100% real. Bid offers showing exactly the trades that are going on in the market. We have full visibility into what's going on. And not only that, then it's backed up by analytics. The analytics here is data where the data comes to you. You don't have to go look for it. So if you have a portfolio, it shows you what are the things about that portfolio that you have. What's the most recent news about it, both from analysts or from the NSE itself, corporate action, anything that pertains to you. So this is customized information for you that relates to what you own so that you can take action on it. Then there are a ton of other analytics that comes with it. So it can show you, for example, what's your best performing equity holding, what's the percentage, and should you potentially look at getting out of that? What is your average beta? What's your average risk in your portfolio? Is your portfolio risk greater than the ASI? So that you can make informed decisions. So it guides you in how you can react to those kind of things. So these are just some of those kind of analytics that it presents. Then to try and round up, who benefits out of this thing? So we were very clear in what we're doing. So we looked at this thing, we needed to cover the entire ecosystem from the onboarding process, the brokers, and the NGX itself. We make sure that all the entire ecosystem is covered, integration with CSCS so that you can register and trade within that 60 seconds. Right now, you can register and get your CS account number for trading within an hour. We've achieved that. Our goal is to stretch this out to up to 60 seconds. And again, like I said, this is not a proprietary platform per se. It's an open-ended platform with an open-ended EMS API that anybody, including independent fintechs, can come in and use. So that's a quick summary of this. So just to let everybody be aware of what's going on and to participate in this market, and then we can move our market forward. Thank you very much.
Thank you very much, Uwa. Very, very interesting stuff you have there, and no doubt we'll be unpacking it a little more as we transit to the Q&A during the panel session. So we will save the questions for later. If you have questions, please, as I mentioned earlier, feel free to type them into the Q&A field and we'll be taking them as we move along. But for now, I would like to now move back to Mr. Femi Balogun, Head of Market Services at the Nigeria Exchange. And I think he's ready now to deliver that themed presentation. So it's back to you now, Femi.
Thank you very much, Wale. Sincere apologies to everyone. The issues we had earlier, I just had some technical glitch here. Okay, so I'll just drive right into it. So the theme for this here is our market data powers investment strategy using derivative product. So this is the table of content, things that I'm just going to talk about. I'm going to go into what we did in 2020, and it was like a precursor to what we're doing right now. So in 2020, that was when we had the COVID-19, and our market data was around that October, November side. And we had to, because COVID wasn't something anybody was expecting, so it was a shock. And so we decided to use this theme, handling shocks in capital market, a quantitative risk management approach using market data. There's a reason why I went back to it. When I get to the next slide, you guys will see the reason why. So the primary focus was calibration of risk models. That's all we talked about mostly. We talked about how to calibrate models and to manage risk from the quantitative aspect of. So we defined shocks. We talked about shocks, what shocks it is when it comes to economics and using econometrics and things like that happened during that time. And we now address, these models in such a way that we look at the role of technology as well too. So we did that last year because of the situation that we had. So we wanted to, because at that point in time, we at Market Services and NGX realized that most of the portfolio managers, most of people in the market will have to protect themselves. And this is where you see where your models, how it's actually reacting to what is going on. For people on the quantitative sides, this is what it's not what they wish, but this is what they want to see, how good the model that I developed, how good it is to handle what the guys have asked for. So that was the reason for that. So in that, we'll look at shocks. So now we'll look at it from the perspective of how, because we're going to have diverse groups, we're going to have people that are well-versed in the quant sides of finance. We're going to have people that we're going to have traders, we're going to have policymakers, we're going to have everybody, even retail investors. So we wanted to balance it. So we now use the shock absorber of a car and what happened in the shock absorber of a car. Because if you look at different kind of cars, Mercedes, Bentley, Hondas, all of them, they all have shock absorber. But if you look at the price or the value of the shock absorber is different. And that is what we talked about when we look at models itself. So we'll look at our own models. We'll look at what we have on both left and right side. What we have both left and right sides. We looked at it. And we now use the model. So the models that we have is the shock absorber for capital market. The shock absorber picture is what we use in the car. So we wanted to relate both of them so that everybody knows that, okay, this is what we do on this side and what actually assists us to get to that. How do you calibrate these models? And that's what we use the data for. And that's why Market Services, the custodian of market data, the exchange, we do have a hybrid set of people that have expertise in stuff like this. So, and it's part of our KYC actually, because you have to be able to speak to these guys on both sides. So we compared both. And the reason is, if you can look at what we have with shock absorbers, we use exact same sentences, and we now slot in what we do on the capital market side and what is like on the mechanical engineering side. So we use that to talk about it last year, but emphasizing the calibration part of it. Now, 2021, like my CEO said, you can see that the World Federation of Exchanges in 2020, what happened? Derivatives market rose by 40.4%, better than 2019. Why is that? Because of the activities that happened last year. So everybody now needs to go and protect themselves. And where do you go and protect yourself from the cash market? You go right into derivatives market. So there was a lot of activities in derivatives market. And that was the reason why we talked about risk management in 2020, because we didn't want to really mention derivatives per se, because we haven't launched it then. We're very close now, extremely close. We haven't, so we didn't want to talk about it. So we now talked about something that implicitly, reference derivative And because derivative is what we use to manage risk in the capital market. So that's the reason why our theme of last year was strictly about calibration of risk models. And this year, we're now talking about derivative itself. So that was the reason why we had the theme of last year. Why did I have to use this? Because I want to relate what happened last year to this year, because they're basically very, very, they correlate together, because without these models you're talking about, you can't be even go into the market to go and trade this derivatives product. So that is the essence of why we had the theme of last year and what we have this year. So now I go into to what we're talking about this year. Who are the players in derivatives market? You have the speculators, the hedgers, and the arbitrageurs. In the introductory video, Dr. Akiyemi alluded to that. The speculators is someone that's coming to do speculative trading, figure out something that happened and take a position in it. An hedger have some position that they wanted to protect. How do I protect it from downwards? An arbitrager saw the mispricing. So you can see the calibration that we have to use is very critical, because if an arbitrager realizes that there's a misprice in any of your securities, then there's an opportunity. Theory says that the market activities were eliminated, but yet some people will benefit from it. So these are the three major. And what is common to these guys, what is common to all of the activities is market data and technology, because you have to do simulation. And for you to do simulation, you have to be able to run it on nice technology, because you might want to do 1,000, 10,000 simulation within 1 hour. How do you achieve that? Now you need sound, reliable data. And the reason for that is this, is no matter how good your model is, if you calibrate it with the bad data, your model is not going to react well. So then that's the reason why exchanges around the world, including ourselves, we basically spend a lot of time in making sure that the data that we present to the ecosystem is extremely reliable and there's sort of confidence in it. And that's why you have vendors like Infoware, Reliance, Refinitiv, Bloomberg, Six Financials, all of them, because they want to get the data from the source. You can go around on the net and try to get the data where you want to get it from. The guarantee is not there. That is the essence why we have these vendors in our market. So I've talked about the roles, and you look at monitoring volatility, the role of market data and derivatives market. You have to look at your volatility. You have to look at your technical analysis, the pricing of your derivative product, very critical, and the risk management aspect of it. So then I go to strategies, and I talked about, I'm not a trader. I've never traded before, but I have some ideas about the things based on the questions that I've asked in the past. So I'm going to look at the element of derivatives trading, just on the strategy part. We are going to, the first contract we're going to have is the index futures. So now if you're an hedger and you have a position that you want to hedge, the contract size now becomes critical to you. And that was the reason why we wanted to talk about the contract size. How do you determine the contract size that you want to take? There are methods that you have to use to do that. Because for example, if you have, let's say somebody that have, another advantage of derivative is you can be in another asset class. So I could be trading in natural gas. I could have, even in the spot market of natural gas. So I could go to an aggregation company and basically have sets of series of deliverable of natural gas, and we're exposed because let's say this is 5-10 years contract that we have, and the deliverable is sequence. So we're exposed. We can turn around and figure out if we come to the capital market at the exchange and see out of the derivative products that they have there, let's say the index futures, for example, because in the index futures, in the underlying, which is the index, you have some energy companies in there. So you can use that to get an idea how they're doing. So in that kind of situation, you can come over. Now you're in the natural gas business, but you're coming to the capital market to hedge your risk if there's correlation between. So how do you get the edge in the size of your contract that you wanted to go into the market to exercise? You need to get the contract size. And if you look at what we have here, you need to get your edge ratio. What is the ratio between the spot market that I'm in, let's say natural gas, or it could be equities itself, because your portfolio might not be directly correlated with, when it comes to the size and everything, with what we have at NGX 30, for example. So then you go to, and you wanted to edge it. And so you have to get your edge ratio. When you have to get your edge ratio, then this is the formula for it, the one I'm pointing to here. And if you look at it, you need to get to the standard deviation of your spot market. You need to get the standard deviation of the futures. That's the volatility of it. Then you need to get the correlation. Now, I put the correlation there. I use this because of the fact the correlation is there. Now, the one thing there is that the correlation is saying that the relationship between the two assets is linear, but that might not be true. And that's where the market data comes into play, because you need to determine the relationship between them. And that's why market data, historical data, plays major role in actually for you to get your edge ratio. So when you do that, then you have to now talk to the guys that understood the theory behind it, come to the vendors, Infoware, others, Refinitiv, get the data from them, run it through your model, figure out what the correlation is. And even if you don't want to go that route, there are some of them for your edge ratio, you can use the beta. When you want to use the beta between the combination of them, comparing both sides, the beta 2 actually needs market data for you to determine it. So you have to go through that. Even if you want to use analytical methods to do it, you still have to come back to this data. And that's the reason why at the exchange, we're emphasizing it. And now that we're even starting index futures, one of the major things that you can look at for today now is you can't even get the standard deviation of the changes in the futures price because we're just launching it. So then in that case, you have to do estimation. When you have to estimate it, you might have the one for your sports, the one that you want to edge, but the one for the futures, you might not have that, and you have to estimate it. Then how do you estimate it? You have to find another underlying that is a proxy to NGX 30 or NGX pension. So you have to now, you come back to the market data as well too. You have to have a proxy, because the proxy is what you're going to use to be able to estimate what you want, because now you don't even have the data itself. So you use combination of your knowledge of theory and practice to be able to estimate that. So that's it when it comes to contract side. There's more to it, it's complex than this, but we just wanted to just talk about the beginning part of it. Technology also plays a major role in it, because when you're doing the estimation, you might have to simulate your model to see that if it is close to what you're expecting, and to figure out what are the errors that I have in it. For speculators and arbitragers, is a mispricing. Now look at it from this perspective. The NGX 30 constituent might have a misprice in it. If there's a misprice in it, then that means in the underlying there's a misprice. Then if I'm an arbitrager and I figure that out, then I can take a position. The only way I can take that position without not going to the cash market to buy those securities is going into the derivatives market. That's where I can do those kind of activities. So the next one that is very critical, and I apologize if it's a little bit technical and kind of like getting boring, but you can get the message I'm trying to get across, is determine the interest rate. Interest rate plays a major role in derivative product. I don't think I've run into one that doesn't have directly or indirectly with interest rate. The way that we compute the forward rate is pretty much simple. We have this. And so you can get, and for you to be able to do that, and let me even start from the definition of forward rate. Forward rates are implied interest rate by the current zero rate for the period in the future. Zero rate are interest rate earned when holding an investment, and the interest and the principal are realized at the end of the holding period. So for you to get your forward rate, this is the formula. In Hall's book on derivatives and options, you see it there. Virtually everywhere you see that formula in there. But there is an hidden stuff in that formula. When I transform the formula to this, which is exactly identical, there's somewhere I'm going with this, so just bear with me. When I transform it into this, for those that have quantitative background, or those that understood what slope is, you will see that the one in the parenthesis, that is the slope of a curve. Now, What that is saying is that there's a relationship between the interest rate that you've got and the time, the maturity. That is the zero curve. Now you need to determine that. So now I need to determine the zero rate. For me to get my forward rate, I need to determine the zero rate. The only way I can determine the zero rate is through the coupon bearing bonds. So we have fixed income instrument on the exchange that are trading, that have activities. The price of those activities there is what you can use to estimate it. So now you're back to, no matter where you want to go, you're back to this market data when it comes to fixed income. Now, then even if you say, okay, all right, I want to avoid that. And I want to make a simulation to say, okay, all right, let's assume that the difference between the period is very small, is insignificant. I didn't want to use all the technical terminologies, but I think that Dr. Easy and Dr. Mary Akiemi basically will be smiling with what I'm saying now, because I'm not using the terminology they're expecting me to be using because of the audience that I have is vast. So let's assume that it's significant. Then this that I have here now becomes this. Somebody from analytics can say, I can do it, but now there's a catch there. You have to estimate the R based on the parameters. So whatever the parameters that you're going to use to estimate it based on time, then you still have to come back to the market data to be able to, you have to go through the market data, both whatever parameters you want to use, you have to use it to be able to determine what that R is. So in a nutshell, it now shows that the activities of fixed income on NGX is now paramount for anyone that plays in derivatives to determine the interest rate. For example, if somebody puts in, let's say that we're fully launched and we have the price for NGX 30, let's say that expires in March, we have it up there, and the value says 1,657 Naira, then I come and I put in an order of 1,670. For example, you can determine, when you see on the order book, you can determine what my implied interest rate is by looking at that. Then if it is all from your interest rate, so that is the game that we're playing now. Well, I shouldn't use the word game. That is what we're doing now, because now I need to understand the interest rate that guy that's put in the bid side, what he's thinking. Then all of these things. So now you have to have several exercises to determine your forward rate. And that's where you have the Treasury departments and all these financial institutions, and you talk to some of them and things like that, get an idea of what is going on there. Then the activities on NGX, you gather all those trades, the prices, you try to figure out what is going on from there. Then you now give the advice to the trader and say, this is the position that you have to take. So I just wanted to talk about just those two. Now, how do you access it? The major thing is you have to be able to access this data. So what we have is the classification of the clients that we have. We have our vendors, we have our index creators, people that use market data to create index. We have our broker dealer funds manager. We have the broker performance that Rosemary spoke about earlier. We have that, and a lot of things went into getting that. So I think that in conclusion, I'll say to everyone that data bridges the gap between theory and practice. Because whatever you do in practice, whatever you say in theory, you have to go into practice to do it. And derivatives incorporate theory and practice because all the sophisticated tools that are readily understood by scientists and heavily depends on the availability of reliable data. The interplay between theory and practice has proved to be an extremely fruitful ingredient in the progress of science and modeling in particular. It is general belief that practice can help to appreciate theory because now it's very essential. You can see that most of the thing I spoke about, there's theoretical stuff in it, but we're doing it in real life. Thus, generating feedback that is one of the most important and intriguing aspects of modeling. And more generally, a scientific investigation. If theory becomes deaf to feedback of practice or vice versa, great opportunities can be missed. It may be a pity to restrict one's interest only to extremely abstract problems, that is when you talk about guys that are doing things on the abstract and things like that, that have little relevance to those scientists or quantitative analysts working in real life. A typical example to the gap is the computation of VAR, expected shortfall, and expectance. That's a typical example of it. And I think I'm running out of time, so I can't really go into that, then data technology. So I want to thank you all, and I want to apologize for the technical issues I have at the beginning. I hope that I've kicked off our conversation. When we get to the panelists, we'll expand more on this. Thank you very much. Back to you, Wale.
Thank you. Thank you very much, Femi, for the insight. And as he mentioned, index futures are coming, and I hope that this presentation has been useful in trying to understand the dynamics as we move forward. Many thanks. On that note, I'd like to now draw your attention to a presentation, another message from some of our partners and sponsors.
If it don't close, I go find another. If I fall down, I go try to recover. If it ever walk me, I know they bother. Cause I believe say I go surely prosper. You don't get that shit, won't be. We move.
Whatever life brings, we move. Turn up your dreams. MTN. Everywhere you go.
Many thanks to our partners today, of course, MTN and Reliance Infosystem. And we'll be listening to representatives of Reliance Infosystems next. They will be making a presentation on unlocking the potential in data as an innovation driver in the financial markets. And making that joint presentation, if you like, we have Eniola Benjamin Ade-Joseph, who is the Group Head Data Excellence Unit at Reliance Infosystems. And also joining Eniola is Mustaqim Quadri, who is also a member of the team at Reliance Infosystems. So I'll hand over to you both to make your presentations.
Hello, everyone. My name is Mustaqim from Reliance Infosystems. With me is my colleague, Eniola Benjamin Ade, and we'll be speaking on the topic, unlocking the potential in data as an innovation driver in the financial markets. The big question is who? Who needs this data? Chinedu, a young and vibrant individual with dreams and aspirations. Chinedu recently graduated university. He has also always dreamed in enlarging his fortunes and his thoughts about investments. Should he instead be saving his money in fixed deposits and let it grow by a little margin, or buy crypto, putting his hard-earned money on an item that is not government-backed, or better still, buy stocks, potentially volatile, yes, and also keeping in mind how the 2008 stock crash affected his parents. Should he be investing in other kinds of assets or buying treasury bills, which is also another option that comes to his mind. Contoso Asset Manager sees Chinedu as a viable customer, and there's a need to help him and other customers in his demographic to invest with as little pain as possible and stave off losses. They also need to help him protect his investment from bad actors. Contoso want to empower Chinedu to achieve his goals while providing a delightful experience. All these leads to what?
In answering the what when talking about data, we'd like to use this slide and sincerely hope that the jarring effect does not offend us too much. But it's necessary to highlight what our raw universe of concerns may be, either as a financial institution or as an investor in the market. For an investor in the market, he's concerned about his numerous expenses. He's also concerned about his financial future and a number of other concerns. All of this come together. But in order for him to make sense of it, he needs to gather data, which are facts and attributes about each of these concerns that can be measured and qualified. We noticed in the chat that somebody actually asked, how do we engage data that is not within the purview of the exchange ecosystem to promote derivative imperatives? Well, the reality is that we need to tap into data coming in from multiple sources, which many people may refer to as big data. If you sprinkle some analysis on that, it gives you a more structured, coherent view of the world where you still have a number of things to keep an eye on, but the relationships between them are very clear. The attributes are also very clear, and it becomes easier to make decisions about these things. But operating at this level still requires a certain level of savvy, which is why when you sprinkle some intelligence on it, where you have automated tools helping to some extent with the decision making, you can have a single pane of glass where all your concerns are represented in groups. It becomes easier for you to relate with, there are fewer moving parts, and it's easier for decisions to be made. Either the financial institution that we highlighted that is representing Chinedu's interests or Chinedu himself. But then how do we achieve all of this? Well, it's all about digital acceleration, allowing digital technology to permeate everything that we do when it comes to conducting business and going about our investment operations. This involves the market operators, various oversight bodies, and the cultural shift that is already inherent in the general populace who would like to invest and grow their wealth. The NGX, for its part, had seen that this was going to be the trend and has over time introduced a number of products. First, they enabled electronic trading by introducing FIX. Then they introduced ETFs into the market to abstract the complexities of choosing which stocks to invest in. And each of these ETFs target people with different risk appetites. Then we have bonds that were formerly the purview of larger institutions, but are now available in the retail market. Then the CBN is introducing a digital currency. Hopefully, if this is accepted, it would increase the range and depth of transactions that all participants can engage in. Now the exchange is introducing derivatives. It's supposed to be a way of hedging against risk so that the wild swings that we sometimes see when there are events on the world stage would not greatly affect the investments of people who are playing in the market. Digital acceleration, managing risk, transformative technology, and banking on change are the underpinnings of everything that is going to happen in the financial sector in the coming years. And this was highlighted at the recently concluded Cybers conference. So then, how do we tame all of this? How do businesses and individuals transform to the point where they can gather data, analyze it, and then utilize it to make effective decisions? Digital transformation or data transformation is a journey. If we can accept the fact that it's not just a clear destination in mind, but it's a continuous process of refinement, then it becomes easier for us to begin to adopt. First of all, identify the various sources of data, set up systems to gather that data, process it, and prepare it. Then build models, which are highlighted by stage 3 and 4 on this slide. That is the intelligence stage where we can begin to use it to understand what we need to do to move our investments or our businesses forward. And one of the tools that we offer from our stable is Trade Office that comes off the shelf with built-in intelligence to facilitate this process. Then in stage 5 and 6, we have a number of tools in our stable as one of Microsoft partners. And foremost amongst this is Microsoft Power BI, where we can gather all these insights, communicate them, publish them, and then measure the effectiveness of all the analysis that we're carrying out, and then feed back into the loop and keep enhancing as we go along. We're hoping that after this event, you would engage with us so that we can carry the conversation forward and explore various avenues that are available to us to richly enhance the investment process, either for the investors directly or for financial institutions that are powering all of this.
Thank you so much. Over to you, Wally.
All right, thank you very much. Very useful insights, so much happening these days, and technology has taken us just to another level in terms of what's possible. So thank you so much for the insight, a lot of food for thought in that presentation. So now we're going to hear from another person, and this time we are going over the Atlantic. He has really been generous with his time, waking up bright and early. He's reaching us all the way from Chicago. Actually, I think it's Northbrook, Illinois. Our next speaker is Dr. Izzy Nelkin. He is the president of Supercomputer Consulting. Supercomputer Consulting is a company specialized in complex derivatives, structured products, risk management, and hedge funds. He holds a PhD in computer science from Rutgers University and is also an academic on the faculty of the University of Toronto. And his firm is a consultancy service that serves regulators, major broker-dealers, large and medium-sized banks, as well as hedge funds. So please welcome Dr. Izzy Nelkin as he presents his keynote address. Thank you so much for joining us. It's over to you, Doctor.
Great, thank you for having me. Pleasure to be with my Nigerian friends again. You know, we've done, over the years, we've done, of course, many seminars and presentations to Nigerian groups. So thank you very much for having me, for having us. So, you know, there's different types of strategies that we talk about. One is called arbitrage, simultaneously buying and selling the same instrument, maybe from two different venues at two different prices and hoping to capture the difference between them. Maybe you can buy some foreign currency at one venue and sell it for a few fraction of a pennies higher at another venue. So I've seen trading rooms where virtually traders, all they do is press F3 on one screen and F5 on the other screen, and vice versa. Then we talk about statistical trading of two related instruments. For example, on-the-run bond versus a regular bond. So the on-the-run bond in the US would be, let's say, the 30-year bond, and the related bond would be the 30-year bond that was there 6 months ago. So now it's 29.5-year bond. So for various reasons, there might be some price differences between them. Then we talk about speculation, which is taking a flyer based on intuition, based on common sense, based on what the neighbor told you or whatever. We can do that too. And another use is to hedge an existing risk, whether it's a company that exports and they have exposure, let's say, to the Nigerian currency versus the euro or versus the US dollar or things of that nature. So one of the interesting things here is that many entities, of course, do better when the economy is booming, of course. So a short position, let's say in the NGX 30 futures, would be a natural hedge, because you're saying, okay, when the economy is booming, I make a lot of revenues, I get a lot of earnings. So why don't I short some, but when the economy tanks, all my revenues and earnings disappear, or some of them disappear. So maybe I should go short in the futures market as a natural hedge. That's just an example. Now, in the US, for example, we can trade the S&P 500 or invest in the S&P 500 via many different avenues. There's a number of exchange traded funds. There are mutual funds that specialize in the S&P 500. There are futures. There are options on the index itself. There are options on the ETFs. There are options on futures. There's structured products, life insurance. There are mutual funds that track the S&P index, but there are mutual funds that track something related to the index, and they might have some tracking error, either by mistake or on purpose. We talk about structured products. For example, people get what we call a whole term life insurance, where you put your excess savings into the life insurance, and that might be tied to the index, and many, many more. So there's a lot of, then there's strategies that take advantage of the difference between the ETF and the futures, or the difference between the ETF and the index, or the difference between options on one and options on the other. It's a difference between options on the futures and options on the index itself, and many, many more strategies that are available here. Now we talk about, and we're talking about indexes, in equity indices. There are many of them. There's like broad index, where S&P 500 that has, more than 500 stocks right now. We talk about a narrow type of index, like an industry group index, for example, a semiconductor index, a healthcare index, etc. Then we talk about various weightings of the index, where it's market cap weighted. That means that the big companies contribute more to the index. We talk about equally weighted price type of index, which is the Dow Jones. We talk about equally weighted return index, and we talk about just a simple average index, like a equally weighted index. So there's many types of mathematical ways of creating the index. The NGX 30 is market cap weighted, and one of the biggest companies, almost 25% of the index. So what do we use data for? Well, people use technical analysis, primarily using the price and the volume data. So some people believe that everything is in the price, so they just use the technical analysis. Others also add what we call fundamental analysis, using earnings, dividends, coverage, price to earning ratios. There's thousands of different types of earnings and ratios that look here, how the earnings compared to last year, whether they're surprised, not surprised, what are the analysts recommending, etc. And now it's become even more popular, or there's some entities that are going one level beyond that. They send a drone to fly over the factory and count the number of departing trucks to see how much they're producing. One of my friends, he runs a little fund, or actually a big fund, and he has a representative sitting in the court and trying to figure out what the judge is going to rule before the judge makes a rule, and see if some patent dispute gets judged one way or another, gets resolved one way or another. And now, the new fashion is what we call the ESG investing, which the investors want to know, how are the companies doing in environment, social governance? Are they polluting the environment? Are they working for the social good? What is the governance policy of this organization? So this is kind of the new, maybe newer fashion in this thing. When we talk about futures curves, we also talk about the shape of the futures curve, which we call contango, that the far maturities, the more you go into the future, have a higher price. So it's what we call an upward sloping. And we call something in backwardation, where the near maturities have a higher price and the far maturities have a lower price. So, if you think the whole economy is going into a recession, you might see something like that. One of the things that happen is this globalization and democratization of finance. Almost all the data is instantly available to everyone. what do I mean by that? Up until recently, if I wanted to find out some information about a company in Japan, I'd have to write them for the annual report. I'd have to send a letter. They would send me back a package with the annual report in Japanese. Well, now it's available on the internet, and I can quickly, instantaneously translate it to English, et cetera, et cetera. So the issue is, can I find an advantageous source of data? Of course, not insider trading, because then you end up in jail, but can I find some advantageous source of data or advantageous source of analysis or anything like that to give me some kind of an edge? And that's where the data becomes really important, and good data becomes important. Another development that we see happening, and some of the speakers already talked about this, is this whole idea of artificial intelligence and machine learning, AI and ML. So all of these algorithms, of course, need a lot of good training data, test data, and validation data sets. Without good data, the artificial intelligence algorithm would come up with bad results, of course. And, we also want to try to sometimes understand, why did the robot make its recommendation, or why did the trading robot say something like that to buy or to sell? Why did the trading robot make its recommendation? That's called explainability and interpretability. We actually wrote a few recent papers about the AI and ML, especially in finance. So if you're interested, I'm sure we can find some copies. So for index futures, as some of the speakers said, of course, the interest rate is important. The higher the rate, the higher the futures value. The dividends are important, because the higher the dividends paid, the lower the futures value. And this is especially important in a country like Nigeria, where both interest rates are high and so are the dividend yields. For example, I saw that Zenith Bank pays about more than 12% dividend yield, which I don't think any, very hard to find a US company that would pay such a high dividend yield. So, that's why the interest rate and dividends are important. And of course, in order to trade these futures, you have to know, as soon as some company changes its dividend policy, or they change the dividends, you have to be kept up to speed on that. So, yeah. So, here's a little secret behind trading futures. So let's say that here's a broker dealer. The broker dealer, in this specific, very simple example, has just two clients. Client number one is long one contract, and client number two is short one contract. Well, of course, client one deposits a margin with a broker dealer. Client number two also deposits a margin with a broker dealer, because both of these clients have exposure to the broker dealer, so they have to deposit margin amount. But if the broker dealer now is representing himself to the exchange or clearinghouse, because the broker dealer has offsetting contracts here, the broker dealer is flat, does not have to deposit any margin. So the broker dealer can, in the meantime, use this money for something else. Now, if you multiply this example by thousands and thousands and thousands, of course, it's not going to be zero, but the sum of all the margin that the broker dealer has to deposit with the exchange or clearinghouse is, of course, lower than all the margins that were deposited with the broker dealer. That's why broker dealers like high volume, and they also like high interest rates. And with that, we always have this question: can interest rates be negative? So this was, for many years, it was just a theoretical question. We, of course, never anticipated or never thought that interest rates could be negative. Here you see the US Treasury bill for 1 month going actually to negative rates. And of course, we know that currently 27% of the world's investment grade debt has negative yields. So think about and what happens if there's negative interest rates to all these calculations and the analysis that we've done before. You know, it's one world where the interest rates are high and positive, and a completely different world where interest rates are actually negative. And we had a thing in the exchange where if you had a debit balance, you know, usually they charge you a very high cost if you have a debit balance, but because it took the interest rate directly from the 1 month T-bill, they gave them a credit if they were overdrawn. As funny as it sounds. Okay, so that was, you know, they had to fix the system for the case of negative rates. Now, another type of advantage that people are looking for is speed. So as we know, in the US, the spot market is in New York, the futures market is in Chicago. There's a little bit of a difference between them. So now there's a question, who can connect New York and Chicago, the computers within the exchanges, to make the round trip a few milliseconds shorter? And if you can make the round trip a few milliseconds shorter, you know the cash price and you know the futures price, and you can compare them maybe just a fraction of a second before the competition. And of course, a lot of the exchanges now, they sell what they call co-location services, where you put your server, you put your machine that does your calculations directly in the exchange building, so it immediately reacts with the computers at the exchange. So not only the data, but how fast you can get to the data is also important. Finally, I wanted to thank you for your attention.
Thank you very much, Dr. Easy. Very useful insight into the worlds of derivatives there. Thank you so much for that presentation.
Welcome, welcome.
Over the years, our suite of technology solutions continue to expand in our efforts to serve stakeholders better. In 2019, we launched X Mobile in beta mode to provide market participants, especially retail investors, a convenient, faster, and real-time access to the exchange's activities. Given its success, we released the enhanced version complete with market snapshots, market news, trading license holders directory, and trade simulator in September of 2021. X Mobile is available on the Google Play Store and Apple iOS Store.
In addition to that, we upgraded our data portal to provide a more efficient and user-friendly experience for subscribers. We introduced X Data Portal in 2013 as a repository for real-time, delayed, end-of-day, and historical data for all financial instruments listed on the Nigerian Exchange Limited. The new features include data products, subscription management, payment gateway integration, and a lot more.
As you adjust to the new realities for operating your business and engaging with your customers, let us help you transform your business into a digital powerhouse capable of adapting and taking advantage of today's opportunities. With our best-in-class array of digital solutions, you can conduct your business, receive payments from your customers, and perform transactions quickly, safely, and conveniently, because we've got you covered with the right people, technology, and service offerings. Contact us today and let us take your business to its zenith. Zenith Bank, in your best interest.
All right, thank you so much for staying with us. And again, many thanks to our partners and sponsors as they work with us to deliver today's event. By the way, I would like to again just highlight the hashtag if you are looking to share information about today's event on social media. The hashtag for that is NGX MDW 2021. So again, it's NGX MD for market data, W workshop 2021. So thank you so much. Please share the information and thoughts that you are getting from today's event on social media. Right, moving on, we'll now transit to a panel session, and or many of the speakers that you've heard previously would be joining us for this. So again, I'd like to ask them to please turn on their videos, and as I introduce all the other panelists who would be joining them for this session. Of course, earlier we heard from Uwa Agbonile, who's the CEO of Infoware. Thank you so much, Uwa, for staying with us. But we also have joining us now, Dr. Mary Akinyemi. She is a senior lecturer at the University of Lagos. Dr. Mary, it's a pleasure to have you here. Just to give some background about her, she is an independent research consultant and a senior lecturer, as I mentioned, in mathematics and statistics at the University of Lagos. She has well over 15 years of experience in the academics or academia, and of course in consulting as well as banking. And she has been interfacing with various businesses and clients over the years. So thank you so much for your time. We also have Mr. Ayokunle Adaralegbe. We can't hear you, but it's okay. We'll hear you very soon. Thank you so much. All right. We have Ayokunle Adaralegbe also joining us. Ayokunle Adaralegbe is the Chief Operating Officer of NG Clearing Limited, and I'm sure you'll be hearing a little more about that as we proceed in this segment. He is a risk management expert with extensive experience in enterprise risk management, as well as central counterparty clearing services. So thank you so much, Ayokunle, for your time.
Thank you.
We also have joining us Mr. Joshua Uwendinisu, who is joining us from Zenith Bank, one of our partners today. Thank you so much for your time. He is the head of risk management and Deputy Chief Risk Officer at Zenith Bank. Prior to this, he has been Group Head, Market Liquidity Risk Management, also at Zenith Bank. He has also worked with Standard Chartered Bank as a Senior Market Risk Analyst, and also with United Bank for Africa and the former Standard Trust Bank. Joshua, it's a pleasure to have you join us today as well. All right, we also have joining us today Folagbade Adeyemi, who is the head startups and operations at the CSCS. Folagbade, it's also a pleasure to have you here. And then, of course, we have many of our other speakers that you heard of from earlier. Actually, that's it. And moderating this session will be Mr. Femi Balogun, head of markets at the Nigeria Exchange. So it's over to you, Femi.
Okay, thank you very much, Wale. Thank you so much. Welcome, guys. I can see everybody smiling, and that is good. So you're welcome to this panel. We're just going to go right into it. Actually, we're having conversation, so everybody can chime in, and you know, if you want to say something, maybe you could just raise up your hand and you can go ahead. But I'm going to start with, because we're talking about derivatives and data and technology and things like that. So I'm going to start with from the central of the core of what we are trying to achieve here, which is I'm going to start with Ayo. And Ayo, welcome. You're smiling. We've had, I can hear you. I think everybody can hear us clearly. You can all unmute yourself if you, as soon as you want to say something, you can unmute yourself. We've had several conversations, you know, between myself and Ayo when it comes to data. I remember vividly when he needed to do certain things, and it was coming to the first thing he did was he needed some data to do certain things that they wanted to do. And, you know, me being on the revenue side and I'm thinking about all that stuff, I said, Ayo, you have to pay me for me to give you access to this or things like that. It shows how important data is to what they do. So my question to you is, how does market data assist your organization when it comes to the key things that you do, you know, when it comes to margin methodology?
Thank you very much, Mr. Balogun. Can you hear me very well? Can you all hear me? Okay,
yes,
great.
we can hear you clearly.
Okay, I'll start by first congratulating the organizers of this year's event. I think the topic or theme is very apt, especially given where we are in the derivative rollout initiative. So I think work well done, and also, for what we intend to do. So, I mean, a lot of the speakers have said a lot about derivatives, so I'm not going to go into that. Without any doubt, in your presentation, Mr. Balogun, you did mention about quantitative risk management in last year's, when you were giving the review of the MD of last year's market data. Without any doubt, data, I mean, I've often heard that data is oil. Data is our oil. It's central to what we do. The nature of our business is centrally about risk management. And it's not a subjective risk management, it's actually a quantitative risk management that is based on data. So data is key. We rely on data like data from the underlying prices, historical data up to 15 years, we rely on that. We rely on data on participants, on securities. So for us, we can't actually do anything without data. Why? Because what we are doing is we are pricing risk of investment or in derivatives by participants, by investors. And in order to do that, we need to collect a deposit in terms of collateral. So we rely on this data as an input for us to determine the level of margin we need to get. So for us, data is actually central to what we do. I think I'll just summarize in that sense, then I can follow up with further contributions.
Thank you very much, Amaya. I really appreciate that. I'll go to, if anybody want to have anything to say, I'll go to Joshua, because I'm with the CCP and the next person in line, that is critical to this derivative product, although we're concentrating on the importance of data in this field. Okay, so now from risk management perspective, how has technology disrupted your risk management tools?
Thank you. First, let me just add my voice to what Mr. Daralagbe said about data. I would say that data is like a navigational tool for somebody who is flying an airplane. For him to be able to fly an airplane successfully, he actually needs a navigational tool. Businesses in different form, whether it's derivatives or the underlying assets, requires data. So for businesses to actually succeed, we need data. Data is life, and is oil, like Mr. Daralagbe has said. So in terms of the technology, I would say technology will continue to evolve. I listened to Dr. Isaac when he talks about how you employ technology in taking decisions, whether AI or machine learning. So that keeps changing. But I would say that as an organization, we pride ourselves in technology. In fact, our team talks about based on technology, people, and service. So technology, we take it seriously. So as this is changing, we're actually well positioned to ensure that we're able to meet up with the changes. Our systems that we've implemented in such a way that is flexible to be able to accommodate changes. And from time to time, we actually fine tune that. So from risk perspective, the change in technology has put some form of, I would say, challenge, not totally disruption, which actually gives us opportunity to fine tune our processes.
Thank you very much, Joshua. I really appreciate it. Actually, in 2019, normally market services, we have all these vendors, InfoWare is part of them. So they normally report us, and we look at those that are accessing it and things like that. And consistently, we normally see Zenith it's very interesting that, you and I are speaking. I've actually wanted to meet you a long time ago. I don't know how I could get to you then, because then we discovered that Zenith always get the data, from one of the vendors. And I remember there was a meeting I was having with my colleagues. Anita was involved then, and I was telling them when we're going through it, I said, someone at Zenith is who we need to go and talk to. I said, if we can get a hold of the guys, we can share ideas and know how, from the exchange perspective with what we do, to be able to collaborate and work better. And I think after this event, it gives us an opportunity to all sit together and figure out a way how to enhance, to use technology, and because of what we have access to and what you guys that are on the field using it, we have to make sure that you guys can get things a lot easier. So I'll go to Dr. Mary Akiemi. Welcome. And, she was our keynote speaker in 2019. And actually, we were a little bit ahead. And I think that she was talking about some of this option strategy. But when you look at the role of the clearinghouse, the CCP, we all can see that market data plays a major role in some of the activities regarding the operations of both the CCP and the clearing members. Could you please elaborate from your perspective to our audience? Thank you.
Thank you, Femi. So yes, market data is very key, because market data, we know, is live data on the performance of the underlying assets as well as the derivatives themselves. Now, for us to have a fair price or a fair idea of how to put together a portfolio, you need to understand patterns in both the underlying asset as well as the derivative itself. You need to understand the distribution of the underlying asset. Now, to get the distribution of a, say, stock, for example, or an index, you need to understand, you need to have historical data, you need to have real-time performance data as well. So like someone earlier said, like I think it was Ayakune that said that data is like new gold. If you don't have data to pass through your models or to pass your models through, there's no way you can have a good picture of what the behavior of those underlyings are for you to be able to get a fair price. And a fair price, I'm digressing a little bit here because we're taking derivatives in this conversation. And one of the key sources that keep people like me in research is what is that fair price to pay for that derivative for both the person taking the long position and the short position. And to get that, so this fair price is arrived at using models, statistical models, probabilistic models. And to test the probabilistic models to arrive at those fair prices, we need data to test them.
Thank you very much. I really appreciate that. Actually, she softened it up a little bit when you're talking about the fair price and things like that. We're trying to, because we have diverse groups, so we don't want to get too technical and all that stuff. So I'll go to Falagbade, because you see, we're talking about the derivative itself now. But one of the key things is if you don't have the underlying stable, you can't do anything in that derivative. If the cash market is not stable, you can't do anything in derivatives market. So that's the essence where the CSCS and NGCL play a major role in all these activities we're talking about. Yes, the data is very essential. So now I'll go to you, Falagbade. Thanks for joining us. Now, the reason why I have this question for you is that someone have asked me multiple times that the difference between NGCL and CSCS, but it's good for us to have to hear it from the horse's mouth. So I want you to try to tell us what is the major differences between both entities, CSCS and NGCL. Thank you.
Fantastic. Thank you, Femi, and thank you to everyone for having me here. To be honest, there is quite a bit of material difference.
I think
CSCS and NGCL. Start with the similarities first. I'm still with you if you can hear me. Can you hear me?
Go ahead. Go ahead. Yes, we can hear
you. So I'll start with the similarities. First and foremost, both entities are FMIs, what you call financial market infrastructures. So it can be seen, one could understand why people would be asking the questions, what's the difference between one and the other. But in terms of the financial market space and the
roles they play, it's actually rather materially different. CSES, first and foremost, CSD, what we call the Central Securities Depository. Whilst the NG Clearing is a clearinghouse, a central CCP, right? And from a financial point of view, CSD ultimately carries and maintains the book of the entire market from a registrar's perspective. Register position, and basically what we do is we carry the database and the account balances of all the investors in the market. From an NG clearing standpoint, my understanding is clearly they are a CCP. They play a role of standing in between of the transaction and ultimately performing a risk management role to ensure that the transaction ultimately has a greater level of security in terms of being executed. We also perform the role of, from the PSCS that is, we perform the role of settling securities at the end of the day, ultimately for all our participants and on behalf of all these daily participants, basically. So what we basically do is we collate all the details of the trades that come from the exchanges, carry out the clearing function, which is ultimately tabulating all the obligations, and then ultimately settling them. NG Clearing performs, like I said, a CCP role, and that's materially different. The risk management and the infrastructure and the roles they play, it's almost like night and day. Particularly, one of the major differences for us right now, as it is in the markets today, is that we handle the trading and settlement of securities of stocks, ETFs, bonds, and mutual funds, whilst the NG Clearing manages the asset class that's specifically focused on what's it called, derivatives. I think I'll just stop right there. If there are
all right, thank you very much. Thank you very much, Folagbade. And I know that everybody we're all essential here, but I think that technology plays a major role in everything that we do. If you're doing simulation, no matter how good, and Dr. Mary can attest to it, no matter how good your model that you design is, if you can't use technology to simulate it, to see how it's reacting to real-time or live data, you can't even get anything out of it. So all these pieces are basically essential. So we'll go to technology. And technology even talks about the trading aspect of it. How do we even generate all this data itself? We talk about it all the time. All the data we've been talking about here, it's market data. I remember when when we're coming up with this, then I was having a conversation with my daughter, and she was talking about, when I talk about AI, artificial intelligence and the aspect of machine learning and things like that. So she brought up Ziva. So I was a little bit, I didn't know I don't know what she was talking about. And so she asked multiple questions, and I know that Joshua is smiling, and I didn't know exactly what she was talking about. So I quickly searched. Then I now get to a link, and it was something to do with Zenith. So I read through it. I said, oh, okay. All right, so I could answer all the questions she was talking about because she wanted to understand something about artificial intelligence. Ziva is one of a core example of what Info was alluding to earlier, which is going to allude to and talk about in this conversation. So from technology perspective, how do you mitigate risk associated with trading derivatives instrument? We've gone through this exercise, so how do you, that's why, you're welcome. Thanks.
Yeah, thanks, Sheldon. Thanks for the invitation. So how do we mitigate risk? It's a multifaceted approach that one has to use in mitigating risk, right? And of course, all of it depends on market data. So there's usually pre and post-trade analysis and pre and post-trade risk that you need to cater to using market data. Right? So in InfoWare, what we've done, right, is that especially with the advent of huge computing power these days, is to make sure that we implement a lot of things at the pre-trade level so that you're not trying to mitigate after the fact. Then one of the key things that we've implemented, we actually put this out for everybody to use. We've implemented something available for free on the web, the value at risk. We created a value at risk model, a tool. So such that people can use using just available market data. Of course, you need at least up to a year's worth of information, price information of the underlying assets you want to do. It could be your portfolio, it could be your derivative. You go in there and you can put your information in with respect to a benchmark. And it doesn't just do the value at risk computations. It also includes things like the beta, the risk coefficient, things like the R square that you can use for comparing the thing to see how accurate it is. It will give you things like covariance, a lot of those mathematical things. But apart from that, the key thing though to doing these things, especially in this ecosystem, is to make sure it can be interpreted in a way that is easy to understand. So we use AI and big data analytics for implementing that. So that it's not just shooting out the numbers, or just displaying the graphs or the stuff, but also actually providing an interpretation. The way we look at it is that if you can take that information and take it to your top management guy, and you can just read it out to him and that person can understand it, then we've done our job. So yeah, risk is extremely important, especially when it comes to this derivatives ecosystem. And it's something that we've spent a lot of time on the R&D dollars to make sure it's well and up and coming. So like I said, so on the pre-side of things, the key there is to make sure that things like margin requirement, the cash being met, and as the prices are moving in real time, re-evaluating and doing a mark-to-market in real time against your current set of positions, such that your trade your next trade, it doesn't make you to exceed the boundaries. And it gets more complicated in the sense that there is risk management with respect to the individual that's trading. It could be your trade, your broker, your proprietary trader, and of course the entire brokerage house itself, and then of course the entire ecosystem. So making sure that one person doesn't put everybody else at risk, even though everybody else might be doing the right thing. So there's this collaboration that has to happen, that is happening with NG Clearing, with NGX, the information flow back and forth to make sure that the entire ecosystem is stable and no one entity causes any kind of disruption, which of course increases the reliability of the entire ecosystem and increases liquidity. So I'll stop there for now. Then I can always delve back in if.
All right, thank you very much. You actually, address a lot of stuff in your conversation, but I'll go to Ayo. Ayo, I'm back. The organization, do you guys simulate hypothetical portfolio when testing your margin methodology? I know definitely is yes. What role does market data and technology plays when you're selecting the investment strategy?
Okay, so my response will be limited to what we do, not about investment strategy really. And so in our process, like I mentioned, yes, we do, of course, we rely heavily on data. And also just, chiming into what the previous speaker was saying on technology. See, technology drives the effectiveness of our risk management. And the agility, the speed with which we're able to execute our risk management model driven by our technology is very important. So what we do in terms of, leveraging on hypothetical scenario is that in a closeout scenario, when we have to liquidate a position, of course, we have to simulate and look at what are the movement and the price movement. So we simulate the movement in price up to about 3.5 times what it's actually occurring in the market, and ensure that in the event of that closeout, that we're able to to close out and ensure that we're able to manage the risk that we take. So yeah, so principally, yes, we do a particular scenario, use a particular scenario in simulating that, and I think without any doubt, honestly, data we can't get anywhere without the data that we've been talking about. Yeah, so being able to effectively, manage the risks when we're doing the so one of the things we do is that typically our MPOR, which is margin period of risk, is typically 5 days. Yeah, typically 2 days. So we using a particular scenario, we can simulate, we can extend that MPOR to up to 5 days, and also extend the movement in price up to 3.5 times. So in that, what we do, we leverage on data to be able to do that. So, and of course, in doing that, we leverage on historical data, which I already mentioned up to like 15 years. So yeah, so price the data is very key. I mean, especially price data of the underlying. And also slightly relevant to that is some of the other functions we carry out at the CCP, which are around our back testing, our stress testing. We also use that, of course, to be able to ensure that we have adequate resources to be able to manage the risk we are managing effectively with the right collateralization. So what enhances our ability to do that is that we rely on data and we're able to use scenarios. So in the case of stress testing, you look at, okay, do you have the right data sets and the right resources? If 2 of your participants fail, in other markets, we can do up to 5. So we look at different scenarios like that and to be able to simulate our ability to manage those risks in those extreme circumstances. So to summarize, yeah, data is key, and data is central to our ability to achieve those analysis and those carry out those hypothetical scenario checks that we need to do when we are having our closeout. Thank you very much.
Thank you very much. We're kind of running out of time, but there's a very key questions that I want to ask. I will touch on most of the stuff. The aspect of this panel is to address a lot of stuff that is going on in the market. So there's a lot of questions that have been said. So we're trying to take those questions together and put everything in the question that we're asking ourselves. So I'll go to Dr. Mary. The exchange where we're launching stock index futures, and which is pretty much simple based on the formula itself. But if you look at it, we need to estimate the interest rate. Sometimes the expected dividend yield, if it falls outside what the information we have from the underlying. So in layman terms, how can you explain to our audience how any miscalculation of either the parameters could lead to an arbitrage situation?
Sure. Thank you, Femi. So arbitrage has been defined earlier in the video, so I'm not going to go back to that. Yes, if there's any shortfall, so I don't want to get too technical. Am I allowed to get a bit technical?
I think you're allowed, because there's a lot of questions about this arbitrage that has been popping up, and so you can go ahead, can go as technical as you want to. I believe that most of the people in the audience will basically get what you're talking about. So go ahead.
Fantastic. So pretty much to compute the futures, right, the index futures, you need your implied interest rate, you need expected dividend yield, and you need C, which is time, which is how much time you want to. So it could be 1 month, could be a year, but the time frame for the contract, isn't it? Now, if there's any non-overlap, so what we expect really is future should directly, so the difference between the price of the contract and that computed price should be equivalent. Now, if they're not equivalent, that means somebody has an opportunity to get something without putting anything in. I'll give a simple example to see if I can make it easier. So our implied interest rate is one of those places where people can make some money without putting anything in, so to speak. So if I lock in a contract with a particular interest rate, all right, and then I go and take another position with a different interest rate, all right, because the interest rate is implied, because it cannot be computed. So if you look at the formula, it's an iterative formula. So we can't have an analytical, a definite solution to that equation. So what you have is a numerical solution, which in itself would still be a function of that implied rate. All right. So if I take a position, like I said, with a particular computed implied rate, and I take another position, now what you'll find is the difference there will be the difference in my contract price, and that price would not be zero. Now that little bit of a difference could run into millions or billions of naira or dollars, which anybody could quickly do a cash in, take a long position, take a short position, and cash in and make some money off. Have I made a bit of sense without sounding? I've tried not to sound too technical.
I think that's fine. I think most of us, I think most people in the audience will definitely everybody got what you're saying. I'll go to, we have very few minutes left. I'll go to Mr. Joshua. We've talked about a lot of risk here, and we've actually taken risk to be one word, but in our world, there are almost several aspects of risk. You have operational risk, you have market risk, the methodology for operational risk, somewhat is a little bit different to what you're talking about, market risk and things like that. But we just put everything together and we, look at it from one perspective. Now, so what I wanted to, to educate us on is, what are the differences from your view, between market risk and operational risk? I know that there's a lot of intersection between both of them, but just try, yes, educate us on that. Thank you very much.
Thank you. Right from the definition of market risk. Market risk is actually looking at the losses that could occur as the prices move, the prices of your investment, maybe equity in this case, or it could be fixed income. So as this moves, the losses that will likely occur. So that's what market risk is actually focusing on. Why operational risk on the other side is it touches base on some key elements, such as either failure of processes, failure of systems, as well as people, or some external events that could happen. So it's quite broad, and arguably some have said that it appears to be the greatest risk, risk with the greatest impacts. For instance, we're talking about using of technology here. The technology has to be stable. If it is not stable, then it could generate wrong results or wrong data, which can result in losses. You talked about the intersection. It can actually lead to market risk as well, if there is a failure from operational risk side. Some other operational risk in this context could even be issue of knowledge about the derivative we are talking about, as well as the underlying markets, or error rates. It's possible, as you are putting the data together, you would impute wrong data, which and decisions is now being taken based on that. So these are things, general operational risk issue in this context. But let me just quickly talk about how to address this. For market risk, we've talked about derivatives. It's one of the ways in which you can manage this by taking hedges. Derivatives will provide hedge for movements of prices of equity or as well as the derivatives we are taking. While on the operational risk side, let me just touch quickly. It's important that data quality has to be very, very top-notch. It has to be reliable. It has to be reliable, as well as the protection of the data as well is very, very important. Then training, we need to upskill people, as well as people who are in the process has to be people that are of a high integrity, so that the markets can actually develop and grow. Thank you.
Thank you very much. I think that I've been getting several signals. I think we can go for hours when we're coming about the conversation we're having. But thank you very much, panelists. I think this is very insightful. I will end with this before I hand over back to Wally, that we are using derivatives to manage risk, but yet derivative has its own risk as well too. The model risk is there, your computational risk is there, your operational risk is there. So you're trying to mitigate risk with something that is even risky as well too. But then that's the where you see that the panelists that we have are very, very critical, because as what Mr. Joshua has alluded to, that you have to have the skill set to be able to actually implement this. And you look at it from the CSCS perspective of the underlying, you look at it from NGCL, from the CCP, what they need to do. Model risk is very important to them, because a little bit of wrong calculation could lead to a lot. you have to look at from the researchers. That's where theory and practice basically merge together in our industry. The technology as well too. So I want to thank you all for taking part in this, and I hope to definitely have virtually all of you. Infoware has been since with us, I know from 2019 when I joined the exchange. Zenith has been with us 2019 as we joined the exchange. Last year, NGCL was with us. 2019, CSCS was with us as a partner. And it's very encouraging when you have your stakeholders actually participating in your activities, which shows that you're on the right track. I want to thank Dr. Mary. She has been fantastic when it comes to knowledge. She was here in 2019, and I've had several conversations with her, and with the based on our research and things like that. So thank you very much, everyone. And it's nice that we have this conversation, and I hope that we've passed a lot of knowledge to the stakeholders, and we're open. Market Services is here. If you have any questions or anything that you want to discuss when it comes to this field, please reach out to us at marketservices@ngxgroup.com or contactcenter@ngxgroup.com. Thank you very much. Over to you, Wale.
If it don't close, I go find another. If I fall down, I go try to recover. If it ever walk me, I know they bother. Cause I believe say I go surely prosper. You don't get that shit won't be.
Whatever life brings, we move. Turn up your dreams. MTN, everywhere you go.
All right, I think that was quite an engaging conversation, useful insight into the risks, especially the risky aspect of investing in derivatives. Very enlightening stuff. Thank you so much to all our speakers. And of course, again, thanks to our partners. Of course, we've just seen some of the messaging from Reliance, Infoware, and MTN. So it has been a very enlightening session. And now I'm going to ask that Anita Gopaldas, Market Data Manager at the Nigeria Exchange, will be now delivering a few closing remarks as we begin to wrap things up for today. But please don't go yet. I have a small but important information to pass across right after she's done. So over to you, Anita.
Thank you very much, Oluwole. My name is Anita Gopaldas, again, Team Lead Market Data. We've now come to a close of this insightful event. Thank you for being a part of the 2021 Market Data Workshop. I believe it was a knowledge sharing experience for all of us. But before we come to a close, I say on behalf of my colleagues and the entire NGX team, I'd like to thank the guest speaker, Dr. Easy Nelson of Supercomputer Consulting, LLC, for an educative presentation showing how important data is, to the derivatives, the index futures, AI, ML,
We also like to thank the CEO of Nigerian Exchange Limited, our CEO, Mr. Temi Popola, for giving us his time and support in making this workshop a success. Again, I wish to thank the Divisional Head of Trading Business, Mr. Jude Chiemeka, for his unwavering support to the team, his practical input and leadership before and during the workshop. The Head Market Services, of course, for his wonderful contribution, leadership and steer in making this event a smooth one. We've had a great mix of industry experts in the capital market and in the field of markets and derivatives as panelists. And we would like to say a very big thank you to Mr. Uwa Agbonile, CEO, Infoway Limited, Dr. Mary Akiemi, Senior Lecturer, University of Lagos, Folagbade Adeyemi, the Head Startup Operations, CSCS PLC, Joshua Uwe Dinisu, Head Risk Management, Zenith Bank PLC, Ayokunle Adaralegbe, COO, NG Clearing Limited, and moderator, the Head Market Services, Mr. Olufemi Balogun. Your interactions and insights on the theme has been very educative and impactful. We know that the audience would leave here with so much more information and the importance of data, which will help them make an informed decision. And of course, I'd like to thank our official partners of the event, Zenith Bank, MTN, Reliance Infosystem, Infoway Limited, our gold sponsor, CSCS PLC, and other corporate sponsors like NG Clearing, United Capital Securities Limited, ARM Securities, New Logic Solutions, Codrus Capital Limited, APEL Asset Limited for their kind contribution to this event. Thank you so much, and we look forward to your guaranteed support in 2022 Market Data Workshop. Please do remember to visit the exhibition hall afterwards to further engage with our sponsors and know more about their products and services to help you with your investment decisions. And of course, we can't end this conference without saying a big thank you to the audience, you, for joining us, listening in, and making this event engaging, interactive with your comments, questions, and your feedback. And I'd like to also say a special thank you to the organizers of this event, the corporate comms team, and the core team, Rosemary Ugogu, Demisola Awotayo, and Telma Agindugu, for their overwhelming contribution to making this event a success this year. Do remember to contact Market Services at ngxgroup.com for your market data solutions and needs. We'd love to meet with you to discuss better ways to use market data to gain the most of your investments. With that being said, thank you so much, and we wish you a lovely week ahead.
Thank you very much, Anita. I think all very well said. Thanks all around to our speakers and of course, our partners and sponsors for today's event. I did mention I have some information to pass across, and I just want to remind you, there is the networking and booth tour available. So the same way you join the platform, you can just go right back and click. You will be able to experience that networking and booth tour that is available to you. You have the opportunity to interact with many of our speakers and the organizations that they work for. And I'd like to appeal to our speakers just before they jump off the platform. As you can see, we still have quite a few questions that haven't been answered. So we'll be delighted if you can type in your responses, at least to those that you can attempt to take a stab at. So on that note, I want to say thank you again. As I mentioned earlier, index futures are coming. Let's get ready for that. Hopefully this has been a useful interaction to prepare us for that. And I'd like to say thank you again, and we look forward to having you at the next event. Have a good evening.